Good morning and thanks so much for tuning in. You're watching Trade Talk on BQ Prime. My name is Alex Matthew and with me is Hiral Dadia. Morning, Hiral.
Good morning, Alex.
Well, that was a very quick introduction and hopefully the show will be as snappy as that. We've got quite a bit to talk about today, and in fact the overnight moves in international markets particularly could have a bearing on equities here in India, because you saw treasury yields in the US come off very sharply because of certain comments that were made by Fed officials that seems to suggest that maybe, just maybe, that hike that everyone was talking about may not come to pass. Hiral.
Absolutely. And however, with that, if you see from an equity market perspective, Alex, we are seeing a positive move in terms of Indian markets. If you have to look at GIFT Nifty as well, 80 points up move is what GIFT Nifty is indicating.
And Asian markets are up
right now as well. So what the war impact is likely to be is what we need to ascertain from here on, because a lot of chatter going on in terms of types of companies, sectors that could be impacted globally. But if you have to look at it from Indian market perspective, we're not really seeing a major downtick that's coming in, because yesterday's session as well, 19,500 was that level that we kept holding on to, though we hit a low of 19,480 in trade. All sectors that ended in the red, HDFC, RIL, these two were the counters that actually continued to remain a drag, and you had Bank Nifty that continued to underperform. Again, the PSU banking sector was the top losing one as well. And the breadth continues to favor the bears.
And certainly, and the broader markets, I think, yesterday saw or took the brunt of the selling, because you had the small cap index for once that lost more than the benchmark, though it's been outperforming. 1.6%, thereabouts at the end of the session. So as Hiral was pointing out, the breadth currently is favoring the bears. But let's see what the cues are from the F&O space as well, and see whether that is borne out in that data as well. Agam is joining in to give you that perspective. Good morning, Agam.
Good morning, Alex. The picture is not very different here, because we have seen the benchmarks take a step back, and also a lot of unwinding in puts. That means a lot of writers who had written puts are now moving out of the trade. Let's take a look at what's happened. As far as the Nifty is concerned, we saw fresh longs building in with near 1% increase in open interest towards the shorts. And on pardon me, there was an unwinding of 1%. And on the Bank Nifty future side, we saw a 2.5% increase in open interest towards shorts. Of course, the Bank Nifty is a lot weaker than the Nifty. Nifty for now, the 20,000 mark is once again out of the picture, considering we started seeing some amount of traction the day before. Now it has come back to 19,800 call. That's where we're seeing a lot more writing. And on the lower end, it is essentially 19,500 puts, which also saw some amount of unwinding in yesterday's day of trade, but still has max OI. Moving on to the Bank Nifty 2, we're watching out for 44,500 on the higher end and 44,000 on the lower end. This is, of course, for tomorrow's expiry. And it is essentially the 44,000 options, which is starting once again to see a lot more traction coming in. So all the activity has started to shift lower as well.
Right, I think, and with that, and that's something which is, it seems, getting priced in as well, because since the last couple of trading sessions, we've been expecting something like this. So let's see where we move and whether the earnings season helps to bolster that up move. That could be a potential trigger, but that's a wait and watch. Thanks, Agam, for getting us the details. And talking about earnings, Alex, we have IT.
Yes.
TCS, exactly. TCS kickstarts tomorrow. IT Pack has been in focus as well. If you see TCS yesterday on the back of the buyback news saw some smart moves, and that was something which provided a sentimental up move to the other IT stocks as well. Now let's head across and understand what the IT sector has in store for us. Sumit Pokharna, VP of Fundamental Research at Kotak Securities, joins in. Sumit, good morning and welcome to the show.
A very good morning to all of you.
Sumit,
thanks for inviting me on the show.
Sumit, always a pleasure to speak to you and get insights. Overall, if you see from a sector perspective, the stance that we've been looking at is that the pace of deal to revenue conversion, that is something which is still indicating a slowdown. And overall, the guidance is something that all of us are eyeing as well in terms of what could be in store for the second half of the year. Taking overall TCS, Infosys, HCL, Wipro, Tech Mahindra, as well as the other smaller names into consideration, what's the sense that you pick up from a sector perspective, and then we can deep dive into stocks?
Yeah. So broadly, you have correctly mentioned there has been not much uptick so far. The revenue things are concerned, particularly for this financial year, that is FY24. In fact, Q2 FY24, we expect a muted revenue growth for tier 1 IT companies, which includes Infosys, TCS, HCL Tech. So broadly, what is going wrong here is that clients are rationalizing discretionary spends. They are also postponing their existing programs. So as a result, revenue leakages are there and weak revenue trends are there. So, and particularly if you talk about which sector are getting impacted, we believe weakness is broad-based, and more particularly, it get amplified in banking, retail, and telecom sector.
Fair enough. Okay, so that's the perspective on the sectoral front. But Sumit, we've also seen Accenture results, right? And I think the entire street looked at those results and said, look, it's not going very well for the IT industry as a whole. Some people have cautioned that that may not provide the entire picture. What's your perspective? And therefore, what's the outlook for the second half of the year from that perspective?
So we expect a muted revenue growth in FY24. However, we are bullish on FY25 based on the recent large deal wins, and the market is bullish on IT sector, particularly, and that's why the stocks have has inched up, mainly because of two reasons: announcement of large deal wins in the recent past, and secondly, everybody is expecting that earnings growth will improve in FY25. And we have already seen, we are already crossed the first half of FY24, so market is focusing on FY25 now.
So Sumit, let's talk about company specific. Two companies that give out guidance. Do you think Infosys and HCL Tech will deliver on the guidance that they've given so far?
The good part about Infosys is that the market expectation is very low because they have already taken a guidance cut in the last quarter. The guidance which they are given in the large deal which they have announced, I think they will to meet that. The surprises will most likely will be coming from HCL Tech because there is a high expectation after mega deal announcements, which an aggressive guidance which the company has given. So there can be some positive surprise on HCL Tech. Infosys, they might increase their lower end of the guidance, but we need to wait and watch for that. And persistence in the mid-cap space, we expect strong revenue growth in this quarter.
But specifically on two counters, or two companies rather, Sumit, on Wipro, the question about revenue conversion, and for LTIMindtree, with respect to the guidance revisions that they have, is another on the cards, and would that be a significant negative?
Right. So Wipro particularly, we have been negative for quite some time because of the poor delivery as compared to the its peers, larger peers. We expect there can be some major disappointments coming, and Wipro will be among the in the large space. That will be the company which will be reporting the weakest growth. So we are not very gung-ho about Wipro. So far, LTIMindtree, we believe the company is doing good, but given the valuation, we find it very expensive at this point in time. So we will wait for some more clarity from the management about the revenue growth trajectory and other things. So, and that thereafter we will look at LTIMindtree.
Right. Sumit, let's talk about TCS that will be reporting numbers tomorrow. Now, one of the key things we are looking at is that the work from home has ended for TCS, which is actually aimed at fixing the utilization. So will it actually help TCS fix the utilization? And secondly, the buyback that could be announced tomorrow. What they've said is that they would be looking at it. When we look at the net worth of the company, and as per calculations, it seems the maximum amount that they can buy back is around 22,000 odd crores, whereas they have seen 18,000 odd crores in the last one. And I think the previous buybacks, they've raised around it was around 16,000 odd crores. What's the sense that you pick up with regards to TCS as well as on the buyback?
TCS, for two things you have asked. First about the margin thing, and as you have mentioned about the increase in the work coming back to office. So we expect marginal pressure on the EBIT margin of most of the large cap IT companies because of two specific reasons: increase in the travel cost. Then at the same time, if you will see, the growth rates are expected to get muted. So that will again be a lever for that. Thirdly, if you look, bringing back employees to office will also lead to some increase in the cost. So we are expecting some marginal margin pressure in Q2 FY24 for most of the large cap IT companies. Coming to TCS, so far buyback is concerned, we believe buyback is just another way of giving dividends to shareholders. So we remain, though this is sentimentally positive for shareholders because generally the buyback price is quite higher as compared to the current market price. But finally, eventually, what the investors will look at, what will be the revenue growth trajectory and how is the quarterly performance coming. So in this quarter, the main focus area will be the deal wins, clarity on the deal pipeline, and anything if they can talk about on the margins. Definitely buyback will provide some downside to the stock price, but most earnings will be the key determinant for future growth prospects of the company.
All right. Sumit, thanks so much for what has been a very lively and insightful chat, and it sets the context perfectly, I think, ahead of the earnings season. Look forward to our next chat.
Yeah, thank you very much.
All right, let's shift gears and talk about a few other stocks that will likely be in focus today. And one of them is from the metal pack, Tata Steel, because it has seen a revision in its debt rating. It has now been made investment grade, and there is a change in outlook as well. To talk about that and to tell you what the context is, I'm joined by Himansh. Himansh, what are you picking up? What's the latest?
So Tata Steel, now this Fitch upgrade comes right after a recent Moody's upgrade a couple of weeks back, and the company was raised to an investment grade by Fitch, with the outlook revised from BB plus to BBB minus, and the outlook has also been revised to stable from positive. Now this is on the back of reduced uncertainty and risk from Tata Steel's UK operations. Fitch expects its UK operations to become more cost competitive in the coming 2 to 3 years, and the key rating drivers here are the raw materials sufficiency in India and its ambitions to double down on its capacity by 2030. And the risks to its financial profile are also mitigated by focusing on maintaining a net debt to EBITDA levels of about 2%, about 2 times or lower. The UK business, which reported a loss of around 130 million pounds in the last fiscal, will see some improvement moving along, primarily because Tata Steel plans to replace its blast furnaces with more cost-efficient and environmental-friendly electric arc furnace-based steel making capacity, as well as the low-cost base in India, where Tata Steel derives 100% of its iron ore and 22% of its coal requirements through the company's mines in India, which serves as one of the lowest cost asset providers in the world. Now, this provides significant insulation to the company in terms of commodity and steel price shocks that have been, looming, fears of which have been looming around recently. So that's what's been faring for Rich. And the last time I think the stock noted a 2% uptick after the Moody's upgraded it. And I think a similar reaction could be expected this time as well.
That's going to be interesting to watch out for as well. So let's keep our eyes absolutely on Tata Steel. But Himansh, you've been tracking the insurance sector also pretty closely. Yesterday, we did see updates coming in. What are your key takeaways and what stocks will be in focus? Because somewhere we've seen a reaction, but what are brokerages making out of it now?
So insurance sector, their September monthly update came in, and brokerages had the commentary has been much in line since March onwards, where private players have seen an uptick in their market share led by SBI Life. Individual WRPs, or the weighted received premiums, which is the total premiums received by insurance companies from individual retail and not group policies, basically, have been growing by 12.3% year on year, whereas the industry growth for the same has been around 9.7% year on year. LIC posted a muted growth of 5% year on year, which caused a drag on the industry growth overall. And amongst the private pack, ICICI Prudential was the only one to report a decline of 5.3% year on year. The market share for private players collectively stands at close to 69% on an individual WRP basis. Their volumes have seen an uptick by about 10-11 odd percent. And in terms of brokerage preferences, they are set for SBI Life being the top one, Max Life, which reported a 28 to 30 odd percent increase in its premiums, retains on the second spot, HDFC Life and ICICI Prudential, that is. The Max Life reported the numbers around 28 to 30%, whereas SBI reported a similar number around 16% in its premium received growth. This has been the case with insurance sector, and let's see what the earnings have to say really in terms of the overall performance of the pack.
Absolutely. Thanks so much, Hemant. And by the way, LIC has lost considerable market share in the 6 months to September, as much as 9 percentage points lower.
It was, if I'm not mistaken, 65, 69% earlier.
And it has lost 9 percentage points. So watch out for LIC also on the downside. And the other aspect, which I think has not been mentioned, is non-life insurers, which are also doing well. They've got quite the scorecard in the month of September. They've recorded record revenues, beating the revenue picture, I think, from a couple of months back, if I'm not mistaken. So watch out for the non-life pack as well. We've got several order wins to talk about. And in fact, Varsha is joining in to tell you all about that. We could see some stock-specific action here. Morning, Varsha. What are you picking up?
So a couple of stocks which are led by order wins that one should watch out today. So starting with Mazagon Dock Shipbuilders, where the company has signed a letter of intent with European client for the construction of 6 firm and 4 optional units of 7,500 deadweight ton. This is multi-purpose hybrid power vessels. Now the prices for the vessels would be decided post signing of the contract. Order book as of 30 June 2023 is around 39,000 crores. Then we have Genus Power Infrastructure, where the company's wholly owned subsidiary bagged orders worth rupees 3,115 crore. Now this is with respect to company receiving 2 letter of awards for the design of advanced metering infrastructure system with supply of 34.8 lakh smart prepaid meters. Now total order book stand at over 14,000 crores. Then we have Dilip Buildcon, where company has signed an agreement for a project worth rupees 396 crore in Rajasthan after receiving a letter of acceptance from the Water Resources Zone, which is in Udaipur. The agreement is for the new project planning, design and construction of Devas 3 and 4 dams Tehsil. And this includes 10 years operation and maintenance contract also. An order is expected to be completed within 44 months. Also, the company's order book at the end of June, June quarter was around 24,000 crores, and it expects to receive orders worth rupees 10,000 to 12,000 crores in the current year. So that's huge. Then next we have GR Infra, where Dibang Power, a 50-50 JV of GR Infra Projects and Patel Engineering has executed a contract with NHPC for rupees 3,637 crore. Now the project is for construction of civil works including head race and tunnel race. Share of GR Infra, since this is a JV, so share of GR Infra project is 50% and completion period for the project is 86 months. Also the order book as on June 30, 2023 is around 26,000 crores. Lastly, we have Bhagiria Industries, where company has received a solar EPC project with operation and maintenance and waterproofing contract also in Bahrain. Now the project is with a capacity of 11.40 megawatt peak and has a total value of rupees 104 crore.
Okay.
Right. So lots of auto wins that continue to remain in focus in terms of stocks that we will be watching out for. Companies which have been LOIs and have got LOAs as well. But Genius Power continues to be on my radar as well, because the kind of orders it's been getting in terms of the meters, that's been spectacular as well, right? And the stock move has been interesting. Thanks, Varsha, for getting us the details. So that's that's the entire pack which tells you which stocks to watch out for in terms of order wins. But moving on, apart from these names like Dr. Reddy's and a lot of other names that continue to remain in focus on the back of quarterly updates as well. Saloni is standing by to get us more. Saloni, what do you have for us?
Right. So as you said, we have Dr. Reddy's. So the company was named in an antitrust complaint filed in the California court by Mayo Clinic and LifePoint Corporate Services. So it alleges improper restraining of competition and shared monopoly in the sale of Revlimid. Then we have a whole host of companies that posted their quarterly earnings and updates. So KPI Green Energy posted its quarterly earnings yesterday, which showed that there has been a very positive top line and bottom line growth. So the 34% growth in the revenue is attributable to the rise in the revenue from the sale of power and the sale of the captive power project. The expenses of the company rose by over 480 crores on a year-on-year basis. However, that did not impact the profitability of the company at all. Then we have three companies that posted their quarterly updates. The first one is Phoenix Mills. So the total consumption in the second quarter rose by 20% to 2,600 odd crores. The retail collections rose 23% to 638 crores in the second quarter. And there has been a steady traction in the residential portfolio of the company, with gross residential sales rising almost 3 times on a year-on-year basis to 292 crores. Then we have the second one is Keystone Realtors. So the company recorded pre-sales of 306 crores in the quarter, which was a decline of 32.7%. And the collections of the company rose 70% to 585 crores. And the area sold declined 44.8% to 1.6 lakh square feet. The third one is Container Corporation of India. So the export-import volumes rose 3.5% year-on-year to 9.7 lakh TEUs, and the domestic volumes rose 26% to 2.61 lakh TEUs. So the total volumes of the company saw a rise of 7.6% to 12.3 lakh TEUs. Then we have Sakshi Medtech and Panels, which is a SME. So Ashish Kacholia recently bought 6.22 lakh shares, representing 3.53% stake in the company at an average price of 167.01 per share, which amounted to 10.4 crores. And Hem Fenleys sold 6.2 lakh shares, representing 3.51% stake at an average price of 167 apiece. Then we have news on Reliance Capital. So the company should see some movement today, since according to Bloomberg, the Hinduja Group is in talks with private credit funds to raise about $800 million to back the acquisition of the company. And lastly, three other companies that should see a positive movement are Entertainment Network, DB Corp, and Jagran Prakashan, because of the news that the Information and Broadcasting Ministry has approved new rates for advertisements on government policies and programs on private FM radio stations for the first time in 7 years. So the gross base rate for the advertisements have been increased from 52 rupees to 74 rupees per 10 seconds. And these rates include a 43% increase in the base rate. So the increase in gross base rate will also be beneficial to more than 400 community radio stations that are currently operational in the country.
Interesting point there. Thank you so much, Saloni, for bringing us those updates. All right, clearly lots to talk about over the course of the day, and a lot of action in the equity markets that's just a few minutes away. So do stay tuned for that, and we'll bring you all the live news and updates. Thanks so much for watching. This is BQ Prime.